Ladies and gentlemen, thank you for joining me this afternoon as we turn our focus to Comerica Incorporated, a storied regional bank navigating transformative change, and the strategic move that will reshape its future in dramatic fashion. Comerica began its life in 1849 as the Detroit Savings Fund Institute, and over the decades grew into a regional powerhouse with branches in Texas, California, Michigan, Arizona, and Florida. Wikipedia. Less than 2 months ago, Comerica reached a pivotal moment when it agreed to be acquired by Fifth Third Bancorp in an all-stock transaction valued at approximately $10.9 billion. Banking dive. Under the terms of the deal, each Comerica share will convert into 1.8663 shares of Fifth Third, representing about $82.88 per Comerica share, a premium of roughly 20% to Comerica's recent trading average. Fifth Third Investor Relations. Upon closing, Fifth Third shareholders will own roughly 73% of the combined entity, Comerica shareholders about 27%. Reuters. The merger would create a bank with approximately $288 billion in assets, placing it among the top 10 U.S. banks by size. Retail Banker International. This is more than a headline transaction. It reflects broader forces in the banking industry. Consolidation among regionals, pressure on margins, the need for geographic reach in high-growth markets, and the quest for scale. Let me walk you through the key themes emerging from the Comerica story: strategic rationale, opportunity and risk, and what it means for stakeholders, customers, employees, investors, and communities. Strategic rationale. First, why is Comerica aligning with Fifth Third? For Comerica, the decision to sell comes after mounting pressure from an activist investor pushing for a sale and for strategic alternatives. Bloomberg. A recent filing revealed that in September another bank made an approach, yet Comerica's board concluded Fifth Third was the optimal merger counterparty. American Banker. From Fifth Third's standpoint, the deal checks several strategic boxes. It expands its footprint into growth markets, notably Texas, California, and Arizona, through Comerica's branch network and client base. Reuters. It enhances its commercial banking and middle-market lending capabilities, leveraging Comerica's strengths in those areas. Investing.com. It creates opportunities in wealth and asset management businesses. The combined bank expects to manage over $100 billion in assets under that umbrella. Wealth management. It aims to achieve peer-leading efficiency and return on assets/tangible common equity, benefiting from scale. Fifth Third Bank. In short, the merger is presented as a natural fit. Two banks combining complementary geographies, strengths, and ambitions. Opportunity and risk. There is great potential here. For Comerica shareholders, the 20% premium offers immediate value. For Comerica's customers and employees, the backing of a larger organization may mean more resources, product breadth, and stability. For Fifth Third, the ability to grow beyond its traditional Midwest base and enter high-growth Sun Belt markets is a major upside. Economists have even projected job growth in Cincinnati as the merged entity builds out capabilities there. WLWT. Yet every major merger carries execution risk. Operational integration, culture alignment, branch overlap, regulatory approvals, and cost synergies all matter. Analyst commentary notes the deal is fair, but cautions about integration challenges and potential disruptions. Investing.com. For Comerica, selling after decades of independence means a major shift in identity and strategy. What it means for stakeholders. For customers, the message from both banks is continuity. Both the merger messaging emphasizes, you should continue to bank as you do today until integration is complete. Fifth Third Bank, but customers will want to watch for changes. Branch rebranding, product offerings, fees, digital banking enhancements, and how the combined institution invests in customer-facing capabilities. For employees, while scale may create new opportunities, it may also mean redundancies in overlapping functions, relocation of roles, changes in reporting lines, and culture shifts. The companies must manage this transition sensitively. For investors, the deal is immediately accretive to Fifth Third shareholders, according to filings. Fifth Third Bank analysts have responded positively. For example, one firm upgraded Fifth Third's stock rating in light of the Comerica deal. Investing.com. For Comerica shareholders, the exit represents value captured. Going forward, investors will watch regulatory approval, closings, and how well the cost synergies and revenue growth play out. For the banking sector and broader economy, the merger underscores a trend of consolidation among regional banks, which may lead to fewer but larger players better able to compete with national banks. But consolidation also raises questions about concentration of risk, community banking impact, and regulatory oversight. Financial Times. In conclusion, Comerica's decision to join forces with Fifth Third represents a defining moment in the bank's nearly 180-year history. At its heart, this is a strategic alignment: geographic expansion, digitization, and scale in a market where margins are under pressure and growth requires bold moves. The outcome is promising, but not guaranteed. Execution will determine whether the merger delivers on its promise of efficiency, growth, and shareholder value. As we watch this story unfold, let us remember three critical questions. Can the combined company realize the anticipated synergies and embed new growth in a timely fashion? Will customers and employees experience a smooth transition, preserving service quality and culture? And will the banking industry's consolidation trend ultimately benefit consumers and communities, not just shareholders? For Comerica, the sale marks the close of one chapter and the beginning of another. For Fifth Third, it is a leap forward. And for all of us who watch the banking sector, the implications extend far beyond one deal. Thank you.